All right, so let's just talk about some of those moves in the mortgage market. Slight uptick since the Fed rate cut, but overall, I think the expectation is that we're going to see mortgage rates are going to go down. How is that going to impact the mortgage and housing market going forward in your mind?
Yeah, I think the long run trend for mortgage rates is lower, but we may see some upticks, especially since the market is still priced ahead of the Fed when it comes to how many rate cuts we're going to see this year. So there is some room for those numbers to move together, and it could mean that interest rates actually tick a little bit higher because expectations for the Fed to continue cutting are very high right now. But I think given the improvement that we've already seen, it's a substantial change from where we were in October when mortgage rates were at their highs. If you look at the cost of affording the median price home for sale, for example, those costs have gone down by $340 thanks to these lower rates that we're already seeing. And if you were to translate that into an increase in buying power, that would be more than $70,000 for someone buying what is a typically priced home. So it's a big sea change in what consumers can afford. I think we need to see some time before consumers really become aware of that change. I think we're going to see the bulk of that impact as we move into the spring buying season in 2025.
So, Danielle, let me ask you, a lot of our viewers have bought a house before. So you're talking about this $340 difference in monthly payments. Are people looking to maximize that $70,000 in extra purchasing power, or are they looking to save on their monthly payments?
I think that's a really good question. My expectation would be that we would see some savings, especially given how stretched consumer budgets are right now relative to home prices and current incomes. But so far, price pressure hasn't really relented in the housing market. We've got a market where inventory is improving, but the housing market is still relatively constrained from a supply perspective. So there's likely to be a bit of a tug of war between those two, and consumers might prefer to save, but might feel that they have to continue to spend that extra purchasing power to compete in the housing market.
So overall, you say you believe that Fed rate cuts are going to lead to lower prices in the mortgage market, or lower rates in the mortgage market, I should say. I do want to ask you, as we see lower rates, that's going to put more money in the hands of consumers. Is there any concern here that that money might go to other areas outside of housing? Of course, we do have a housing shortage and kind of a housing crunch in the U.S. But if consumers have more disposable income, is there just a general consensus they're going to use that on big ticket items like houses, or do you think they might actually spend that money in other areas?
I think, for the first step for consumers is to find the house. So this is mostly going to affect home shoppers. We have, already consumers have a lot of spending power based on the fact that many of them are locked into lower mortgage rates. But for consumers right now, I think getting into the house is key. And then that could lead to a modest uptick in consumer spending. But I think it's mostly about housing affordability at this point.